Hey everyone, welcome back to Corporate Decoder, the place where we break down corporate jargon and financial reports. And boy oh boy, do we have a juicy one today. We're diving into ePlus INC's latest quarterly report, and it looks like they've made a pretty big decision about their financing business. Get ready because things are about to get interesting. So ePlus IN just dropped their quarterly report for the period ending June 30, 2025. Think of this as a mid-year checkup for the company. We're going to sift through the numbers to see how they're really doing and what's going on behind the scenes. Now, before we get too deep, you'll see a lot of what they call forward-looking statements. Basically, the company is telling us what they think might happen in the future. It's important to remember these are just educated guesses, and real-world events can always change things. They're talking about things like economic ups and downs, how their relationships with big customers might change, and even the wild world of cybersecurity. Most importantly, they're mentioning risks related to artificial intelligence, or AI, and how quickly the IT industry changes, throwing in mentions of things like cloud computing, software as a service, and infrastructure as a service. These are all big buzzwords that shape how companies operate today. Let's jump straight into the heart of the report, the financial statements. First up, we have the balance sheets for June 30, 2025 and March 31, 2025. This is like a snapshot of what the company owns and owes. Looking at the assets, current assets, that stuff they can turn to cash pretty quickly, stood at $1.4 billion on June 30, 2025. That's a slight increase from the previous quarter. And the total assets for the company, they're around $1.8 billion. Now here's a really important detail. On June 30, 2025, they sold off a big chunk of their business, their financing operations. This means a lot of the numbers you see here have changed because of that sale. On the other side of the coin, total liabilities, which is what they owe, were about $778 million on June 30, 2025, down from over $900 million a few months prior. That's a good sign, likely due to selling off a part of their business. And finally, stockholders' equity, which is what the owners truly own, is just over $1 billion. It's good to see this number growing, which it did. Now, let's look at how much money flowing in and out, their revenues and profits. This is where we see if the business is actually making money. For the 3 months ending June 30, 2025, their total net sales were about $635 and $35 million in the same period last year. Gross profit, which is what's left after you pay to make or buy the things you sell, was $146 million last year. Their operating income, that's profit before interest and taxes, also saw a nice bump going from $31 million to $36 million. And the bottom line, net earnings was $37 million for the quarter. That's a significant improvement from $27 million in the same period last year. This translates to earnings per share of 123 cents, a good increase from 120 last year. So financially, things are looking up. But remember, this includes results from both their continuing business and the part they sold off. Speaking of the sold off part, they call it discontinued operations. They made about $10.5 million from that part in this period, which helped boost the overall net earnings. Next, let's talk about cash flow, how much actual cash they generated or used. For the 3 months ending June 30, 2025, they actually used about $99 million cash from operations. This might sound alarming, but it's largely due to changes in things like how much money customers owe them and how much inventory they have. This is a big difference from the $97 million they generated in operations last year for the same period. In investing activities, they brought in a lot of cash, $155 million. This was heavily influenced by selling that financing business we talked about. And from financing activities, they had about $31 million come in, mainly from borrowing money on their floor plan facility, which is a type of loan to buy inventory. Overall, their cash and cash equivalents went up by about $90 million in this quarter. So even with using cash in operations, the sale of big inflow of cash. Let's dig a little deeper into this big sale of their financing business. On June 30, 2025, they officially sold off their domestic financing business. This was a major strategic move. They sold it to Marlin Leasing Corporation and got a good chunk of cash for it. They say this sale makes them a pure play technology solutions provider. This means they're focusing solely on their tech services like products, professional services, and managed services. It's a big shift in where they want to be in the market. Looking at the numbers for just the sold or financing business, it brought in about $15 million in sales and made $10.5 million in profit after taxes. They also recorded a gain on the sale itself, which really helped their overall financial picture for this quarter. Now, a bit about how they handle their money and borrowing. They have a pretty big credit facility with Wells Fargo, a credit line that allows them to borrow up to $500 million for other needs. They had about $129 million drawn on their floor plan facility at the end of June. This is their main way of paying for inventory before their customers pay them. They also highlight that losing this credit facility would be a big problem for them as they rely on it heavily for their day-to-day operations. Let's look at how they're managing their own stock. They've authorized buying back a significant number of their own shares, showing confidence in their stock and a way to return value to shareholders. They also have a bunch of stock-based compensation plans for employees, which is pretty standard. Now, let's break down how they organize their business after selling off the financing part. They now have three main segments: product, professional services, and managed services. The product segment is where they sell tech, hardware, and software. Sales here were about $520 million, up from $457 million last year. But their profit margin in this segment dipped a bit. Professional services, where they offer expert help and project management, saw a big jump in sales from $37 million to this is largely due to an acquisition they made. However, their profit margin here also decreased. And managed services, where they manage IT systems for clients, had sales of about $44 million, a small increase from $40 million last year. Their profit margin here also slightly decreased. Looking at the overall sales trend, it's clear they're growing. The increase in sales is driven by more business in telecom, media, and entertainment, even though other areas like technology and healthcare saw a decrease. However, the gross profit margins across the board are shrinking a little. For products, it's down because of a shift in product mix, meaning they're selling less of the high-margin software and subscriptions. For services, it's due to factors like integrating an acquired company with lower margins and a slight dip in their service desk business. They also mention some new accounting rules they're looking at, but these are mostly about future disclosures and don't really change how they operate right now. In their management's discussion section, they really highlight the sale of their financing business and how it positions them. They're focusing on AI, security, and cloud solutions as key growth areas, which makes sense given the current tech landscape. A notable point here is their headcount. They added a significant number of employees, largely due to acquiring Bailiwick Services LLC. While they plan to sell off their financing business, cutting some jobs there, it shows growth in their core tech business. They believe they have enough cash and credit to keep things running smoothly for the next year, which is always good to hear. Under risk factors, they reiterate the impact of selling the financing business. They admit their business is now more concentrated, meaning if the tech market takes a hit, they could be more vulnerable. They also state they might not achieve all the anticipated benefits from selling the financing business, and the money they might get later, called contingent consideration, depends on how well the sold business does, so that's not guaranteed. And finally, the exhibits list a bunch of legal documents, most importantly the agreement for the sale of their financing business. This is where all the official details are kindy for us in after looking at this report. On the plus side, their core technology business is growing, with sales up significantly. They've made a strategic move to focus purely on tech solutions, which can be a good thing if they execute it well. Their net earnings and earnings per share have improved, which is always a positive signal. However, there are some red flags. Their gross profit margins are shrinking across the board. This is concerning because even though sales are up, it's costing them more to generate that revenue, or they're having to lower their prices. This could be a competitive pressure or a result of selling more of their lower margin product offerings. Also, the increased concentration of their business in just tech services means they are now more exposed to the ups and downs of that specific market. The fact that they might not get all the contingent consideration from the sale of their financing business adds another layer of uncertainty. Overall, ePlus is in a transition period. They've made a big strategic shift by shedding their financing arm. The growth in their tech services is promising, but they need to get a handle on those shrinking profit margins. The market is still demanding AI, security, and cloud services, so there are definitely opportunities, but they'll need to navigate the competitive landscape carefully. What do you guys think of ePlus's strategic move and their latest financial results? Are they positioned for success, or are those shrinking margins a sign of trouble ahead? Let me know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more corporate deep dives. And don't forget to join our Discord community linked in the description, where we discuss these reports and much more. Thanks for watching, and I'll see you in the next one.